Alright guys, welcome back to MMGinvest. I'm going to cover some TA, the markets. First of all, this is not financial advice. Consult your financial advisor. Equities are extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. Once this video is uploaded, it's pretty much obsolete. And this is more of an educational channel. So there are some big moves coming. Alright guys, and they're probably going to play out in the next 4 months. 6 at the most, but it's coming in 2019, I guarantee you. I'm going to show you. For the short-term time frame, tomorrow the markets are closed. It's Thanksgiving. But right now, we're getting a nice bounce in this symmetric triangle, as I expected. I did buy the NASDAQ E-mini 100. See how that's doing. Right now, it's, what is it, Wednesday, 11:20 a.m., the 21st. And we're getting a little bounce. I will exit this position probably by the end of today's trading day, before the weekend, right? Because a lot of traders like to get out of the markets because you never know what's going to happen over the weekend. And there's a lot of trade feuds and talks with Trump and China. And obviously the mainstream media is like nonstop saying that the markets drop because of the trade wars. And I'm telling you, it's not. It was because of the midterms. Because Trump's going to have a bunch of problems. He's not going to be able to get much done for the next, 2 years. And then there's a good chance he's probably not going to rerun for 2020, or he won't win. Because by then the markets are probably going to be correcting and in a bear market. So we did have a 15% sell-off on the FANGs and a lot of the stock market. But for the short term, I'm expecting a little bounce. Nothing significant. There's resistance around 6,800 on NASDAQ E-mini right here on the daily. But it might not even get up that far. So, especially within the next few days or next week. We'll see. Either way, I'm going to exit. Let's get back to the macro outlook. I mean, yeah, there's still resistance on the way up at around 2,700 on the daily for the S&P 500. Fang Stocks, let's take a look at that daily chart. This is more of a macro outlook from now on. Well, the FANGs have hit major support. A lot of them were down in bear markets, past 15%. You know, FANGs, Facebook, Amazon, Netflix, Google, Apple, all of them. And Apple, I mean, it doesn't take much of Apple to fall to take down the rest of the markets, because these monopoly corps are way overweighted with all of the rest of the stock market. I mean, it's a large percent, over 30% of the stock market, cut through derivatives, ETFs, and whatnot, they have large holdings of the FANG stocks. So the way the FANGs go, the rest of the stock market goes, and then the total economy with it, because everything's over leveraged. And all the corporate buybacks from all the corporations in the past few years has been completely ridiculous. What they do is they buy back their stocks. And the way they could do that is because the Fed, with low interest rates, prints money. The banks, get the money, the cheap dollars. Then they lend them out to corporations. Corporations buy back their stocks, artificially inflating their stocks and creating a giant debt-driven Ponzi. So it hit major support on the daily here, the FANG stocks. It needs to bounce, and it probably will. Short term, intermediate, for the next few weeks maybe going into 2019 for the next few months, and after Christmas and all that, right? And then starting 2019, probably the first quarter, it's going to come back down and retest this major support down here. And then we'll see. It might bounce along and then eventually break down. So I'm expecting something like this, and then boom. We'll see how long this will take, how this will play out. I'm speculating. This isn't anything for certain. I wouldn't trade or invest based on this. But I wouldn't be surprised if it makes a move like that. We'll see. I mean, it could go a little higher. We'll see. We'll see how the trade talks go with China. Like I said, I don't think the main reason the market has dumped is because of China. It's because it does have an effect on it, yes. It brings more uncertainty to the markets, but I think the midterm elections and the Fed raising rates, the combination of all three has really might have. I'm pretty confident put in the top to this market. So let's look at what is this? E-mini crude oil. Also major support right here. So I expect a bounce on oil. So prices are going to stay fairly low though. And then possibly it might rally if it plays out like in 2008, right? So it dumped prior to the mortgage-backed security crisis and then had a massive rally. And then it dumped because the dollar was a safe haven, and then the price fell. And also, it should fall, oil, because, less demand for oil as people transport goods as the economy starts going into a recession. So I'm not exactly sure how oil is going to play out because, governments tend to manipulate oil and with the Saudis and OPEC, so it helps the economy not fall into a recession. They try to buy more time or try to prop up everything with cheap oil. We'll see how that plays out. This will be a good play though if you could time it right. 10-year yield on the bonds. So let me zoom out. This is a 30-minute. Yeah, it is. Here's a weekly. So since 1988, the yield on bonds has been in a bear market and the bond market has been in a bull market. Well, look at this. From a technical standpoint, and fundamentals, I could talk about that all day, right? But from a technical standpoint, look at this on the weekly. What do we see here? A giant cup and handle. And what comes after a cup and handle? Well, technically, from a technical analysis standpoint, cup and handle gives you like a really high probability, something like 70%, somewhere around there, of a breakout afterwards. And if we actually get a breakout past 4% on interest rates on the yield, then what will happen is we'll get an inverted yield curve. Let me find this real quick. I promised on my last video we would look at it. Where is it? Here it goes. So I've showed you guys this before, but the dynamic... Let's take a look at the yield. Because, what's his name? Ray Dalio was talking about the yield. So I've talked about this. Before every recession, the yield curve inverts. So here's the 2008 recession on the right here. That's when it began. But right before the stock market crashed and everything started crashing, the yield curve, this red line, inverted, meaning the lower interest rate, the yield, the interest rate on the debt that matures quicker, on the 3-month, 2-year, 5-year, started the interest rates on them started going higher than the long-term bonds, the 10-year, the 20-year, and the 30-year. Normally, the interest rate is much lower on shorter time, on debt that matures in a shorter span of time. So if you hold government debt for 1 year, the interest rate should be lower than holding it for 30 years because the risk is higher holding something that much longer because a lot could happen in 30 years. In 2 years, 1 year, 3 months, not much, right? And then the central banks, this is how they manipulate the markets and prop up economies and equity markets. They artificially peg the interest rate low on the short-term debt, but they can't really manipulate the long-term debt. So what happens is the free market, or what's left of it, they start selling the long-term debt because they see a recession coming. So what happens is the interest rate on the long bonds, on the longer term bonds debt, they start selling it, and then what happens is then the interest rate starts dropping on the long term debt, but on the short term debt it starts rising because the market sees it as a recession coming, and then it's risky to hold the bonds because you never know. And that's how the market dynamics work in a nutshell. So let's take a look here. We'll start at 2003 when the bull market started after the fall of the NASDAQ bubble, .com bubble, and 2001 happened, right? 9/11. And look at the yield curve right here, the interest rates on the left. As I take the price, as I go across the price of the stock market here, of the S&P 500, I think. All right. All right, now it's starting to flatten. Now we're getting into late 2006. Now we are in 2007. It's inverted in 2007. Really inverted. Look at that. And then boom. It starts normalizing as the stock market starts crashing. All right? And this is the business cycle that's created by the central banks, Alan Greenspan, with artificially lowering interest rates. And Greenspan started doing that in the early 2000s, and that's what also helped create a stock market and a housing bubble, right? And then, with the housing bubble, people refinance their homes, went out, bought cars and TVs and all kinds of crap. That also pushed up stock market, right? And everything else. It creates a false wealth effect, which is misallocation of capital. And then the free market, despite all the manipulation, will eventually correct it. And when it does, because the greater the manipulation, the more painful the correction. All right, so let's take a look at 2009. They printed a bunch of money, QE, lowered interest rates almost to negative, and the yield curve somewhat normalized. 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018. We're starting to flatten, and current time today. It's really flattened. Of course, there's a dip right here because it's artificially pegged at around 2.25% for the interest rates because of the central bank. But eventually, the market's going to push it up, they like it or not. And then once the long-term yields start dipping lower than the short-term, it's signifying, hey, we're about to have a correction, and and this could be the ultimate correction that the world has never seen before because it is going to be global. It already is. Just recently, news broke today that Italy can't get can't get any more money from the EU, from Germany essentially, and they're gonna go the ways of Greece. And get this, the Germany Central Bank, or the EU, they're gonna do sanctions on Italy. So they want their money back, all the money that Italy borrowed, and Italy's gonna end up like Greece, and then Italy's gonna break off from the EU, and it's gonna blow it up, which is it should happen because it's like a socialized central Euro nation, but I mean Italy's gonna break off so they could create their own currency and then print it out of existence, and Italy's known to do that in the past. All right, so let's get back to some charts. Natural gas. This is really interesting. So I'm looking at this is a daily chart. Let's take a look at a weekly. Natural gas is breaking out. Look at this. So it consolidated in this giant symmetric triangle, and it broke out. And I'm not exactly sure why, but it is a commodity. So this is also signaling something here, right? So in 2008, it also broke out while the markets were falling. So that's interesting. Is this signifying another correction coming? Or is this just natural gas on its own? I have to research more into it. I just happen to notice this. Because natural gas is it's a big it's big for traders. Nat gas. All right, let's take a look at the market view here before I go to gold and silver. So the dollar's at still above 96. Let's take a weekly view at this macro. It's interesting with the dollar. I'm not sure if the dollar will be a safe haven or not. It all depends if China and Europe really start falling apart before the U.S., and the U.S. really is the last domino. This is interesting, though. I could almost put a cup and handle on the dollar here on the weekly, which is interesting, right? Look at that. Can metals and the dollar go up together? Yeah, they can. Um, so I mean, the dollar could break out on the weekly, so and then have and then pull back and fall and just crash and burn. It all depends. Because listen, even if the U.S. is less domino, its trade deficit, its unfunded liabilities, all the states' pensions are going bust right now. New York, Chicago, and California, calipers. They're gonna start. They're all gonna start falling like dominoes. And I think the Fed will capitulate and will stop raising rates and might cut them. And it's not gonna be good for the dollar, but it might keep the dollar, I don't know, trading sideways. If China and and Europe's in big trouble, because the dollar will still be viewed as a safe haven from a global standpoint. So it's gonna be tricky. It's gonna be difficult. We'll see what happens. Let's take a look at gold. And I'm just thinking out loud. This isn't financial advice. I'm just real quick going over the TA here. Here's gold futures. We don't have a cup and handle just yet, but if gold on the daily could keep rallying and at least reach around 1235 per ounce, that'll create a cup and handle, and we'll see if it could break out. And if it does that, it's going to catch the attention of speculators. And I think if oil goes past $80 a barrel, that's another catalyst for gold to break out. Obviously, for gold to go into another bull market, if you look at this macro chart, this large weekly chart here, the largest resistance for gold to run like crazy from a technical standpoint here is around 1,380, like 80. If gold could get past that, pretty much 1,400, it's going to break out into a bull market, which could last a few years or years. So that's the macro long-term picture. I could also put a nice ascending triangle right here on the weekly. So cup and handle and an ascending triangle, which are really good technical indicators for possible massive breakout. And I'm going to be bullish on metals for 2019, right? That's why I'm also creating my research, which will be coming soon, guys. Don't worry. By year's end, for hopefully within a few weeks. But I mean, it's very, very time consuming. Here we go. Cup and handle. On the on the weekly, we would need we could also get a cup and handle, right? So there's a little cup and handle in here. But on the weekly, if the price could get up to 1380, it should shoot it up for a multi-year bull market. For well, I don't know about multi-year, but we could easily revisit the all-time highs of 2011 if we get that cup and handle on this weekly inside this ascending triangle and then a breakout, right? So for those gold bugs who've given up all hope, from a technical standpoint, I think loading up would be a good idea. And I have been loading up, taking profits from crypto, and I've been buying some miners, and I'm in it for the long haul, right? So what else can we look at? I think that's good for now, guys. Talked about Fang, US dollar. Talked about all the markets. So if you guys found this informative, educational, give me a thumbs up, share it on Twitter, Facebook, wherever you can, and leave something in the comment sections if you guys want to talk about anything, really. And check out our free Telegram group. The links are below the video. The MMG Telegram group, it's free. We're in there. We talk about metals, miners, economy. For some reason, people are talking about cryptos in there too. And it might be annoying for some of you guys, but I'm going to try to keep it economical and metals and equities in the MMG Telegram group. So we could share ideas and help each other benefit, right? All right, guys, until next time.